Good day traders, this is Roger Scott from Market Geeks with another day trading video tutorial for you today. Before I begin, I'd like to remind you to subscribe to our video channel for trading videos and trading tips. And don't forget to visit marketgeeks.com for your free trading report. Anyone who has basic experience day trading will tell you that one of the biggest challenges for most traders is finding stocks and other markets that are moving with sufficient momentum and volatility to make day trading worthwhile. I can tell you from personal experience that there's nothing more frustrating than getting into a fast market only to see it slow down immediately after my entry order has been filled. Because day trading is based on intraday momentum, you want to make sure the markets you choose and the strategies you pick have enough momentum to justify your risk. You want to start with the daily chart so that you can see the past trading history and the characteristics of the market you choose to trade. I start out by monitoring the stock that closes above a 90-day breakout, or stocks that are closing near a 90-day price breakout. As you know, based on my previous articles, the 90-day breakout produces the highest ratio of winning to losing trades. The best candidates for my trades either gap up to a 90-day high or reach the 90-day high by way of extended trading range. I will show you both examples so you can get a good idea of the type of setup you need to find. Once the stock breaks out above the 90-day high, I wait for a confirmation signal. There's too many false breakouts, and I want to make sure that the momentum is real and not ending immediately after the price breaks out of the trading range. My condition to entry is a gap day following the breakout from the 90-day price high. This means if the price broke out of the 90-day range by way of gapping up, I will want to see a second gap day prior to my entry. You can see in this example how the stock breaks out and once again gaps up for the second day in a row. This would be sufficient for me to justify entering the market. Once you get a solid confirmation by way of a second gap, you can safely enter the market. My advice would be to watch the market carefully prior to the opening and get a good feel for the stock you're trading. If the stock or other market you're trading opens with a gap up, you can safely enter a market order assuming there's sufficient volatility in the market that you're trading. Most market orders get filled instantly, so you will be assured that your condition to entry has been completely satisfied prior to your order being executed. Once your order is executed, you stay with the trade till the closing bell. Since this is a momentum strategy, the odds of the closing price being in the top 20th percentile of the highest price of the day is roughly 80%. So I suggest you hold the trade till the closing bell and exit MOC, or market on close. If you were paying attention a few minutes ago, you might have noticed that I said that the first or the initial breakout outside of the trading range does not have to be a gap, but can be an extended range day. I want to make sure you clearly understand that concept of extended trading range. So this example utilizes a stock that breaks outside of the 90-day trading range through volatility and price instead of gaps. Everything beyond that point is the same, except the initial setup can substitute the first gap if the extended trading range is sufficiently strong enough. There's a formula to calculate the extended range, but I will save you the explanation for another day. Here you can see how the stock's trading range is almost triple the recent trading range of this particular stock. This is the type of strong trading range you want to see breaking out of the 90-day price high. Once you identify the stock with sufficient high breakout range or a gap, as we saw in the previous example, you can begin monitoring it prior to the next day's morning opening session to make sure you see a gap opening. Remember that no matter how good the initial breakout looks, you have to make sure your entry is preceded by a gap no matter what. Here's a perfect example of an extended trading range breakout followed by a gap immediately prior to entry. You can see in this final example how the entry and the exit appear on an intraday chart. Notice I wait for the gap and then enter a market order immediately after the opening gap. The order typically takes about 3 seconds to execute on a volatile market. I recommend you watch the market closely prior to the opening so that you are ready to go when and if the gap occurs. The stop loss level is placed 5 cents below the gap bar, so you should have no problem identifying it and placing it immediately after you're filled. The momentum breakout is one of the easiest and productive day trading methods for traders looking for momentum setups. Remember that the breakout can either be a gap or an extended range bar. Either way, you cannot enter the trade prior to a confirmation gap that occurs at the second opening. Make sure you place your stop loss order immediately after you receive your fill, and don't try to exit the strategy prior to the closing bell. This is pure momentum, so you want to make sure you give the strategy time to work. That's it for today's tutorial. Don't forget to subscribe to our channel for trading videos and trading tips, and visit marketgeeks.com for your free trading report. Wishing you all the best in your trading from everyone at Market Geeks.